So let's close out today with the mortgage rates.
Can I read the first sentence?
Yeah,
please.
Go for it.
December jobs data expected to cool, but how will the Fed officials respond at their next meeting? Oh boy, last Friday were we in for a ringer.
This this is an interesting article because what we
read it and laughed.
What we had been talking about months ago in August of 2024 was mortgage rates are getting a head start before the Fed starts cutting rates. And August was like the lows of the lows.
We're
for
back!
Like all of 2023, all of 2024. August 24 was the lowest rates in that 24-month cycle.
Yeah.
And then they just kept going up. September they went up.
It's
October they went up again. November they stayed up. They took a little bit of a breather right before Christmas, and then boom, December they remained elevated despite the Federal Reserve dropping their interest rate in consecutive meetings.
But Will brought up a good point the other day about employment and how important that is, because all the taxes that they're collecting from employment is going towards paying some of our debt. And what happens if employment comes down? Will brought a great point. Who's paying for the debt? Yeah. Now it's even harder to pay.
The question
they
is,
have to pay on unemployment too. Right?
And then that's another charge that gets added onto the debt.
Yeah.
So it's like a big intertwined circle of if I ease up over here, you're gonna have it harder over here. So it's literally like teeter-totting.
So here's
going to stop.
So here's where I want to go, guys. So we in the fall of 2024, and I'll say the quarter four. Okay, so October, November, December. A lot of our conversations were like, okay, cool. Well, everyone is expecting lower mortgage rates in 2025. Now we're not there. Now it doesn't look like we're going to be there, and it looks like the Fed is going to pause on their rate cuts at their next meeting, and there's a very low chance that they're going to do a rate cut in the March meeting. So now what do we make? I mean, we're just completely, I'll say, at the mercy of the rate markets, but they don't seem to be trending in the same direction, and that's a problem.
So I think what I was going to say to that is that I think that gives us runway for the market to kind of work on its own, because if we see that once they're bringing down rates, it's not bringing mortgage rates down, then maybe holding is going to put off a different effect to be able to at least slowly rates come down into.
But if they don't and they remain elevated, that's going to put price pressure on homes. And then you will see price pressure become the reason why people do price reductions.
Yeah.
So if we get back up to this 7.25, and the further we get away from 6, the more problematic it becomes on pricing.
Yeah. I mean, I like to start off first again. 2025 has been a shit year to start.
We can do it.
Fires. We got fires. We got this ADU shit,
Oh my
and
God.
now we have the worst affordability. We started with the worst affordability ever.
Right.
That's been 2025 to start off the year.
Yeah.
Here's the price compression that's going to happen. We got to think about it. Homeowners look at their home as my home's worth $10 million. It's not. It's worth what the buyer's willing to pay.
Yep.
Okay. The difference between a builder and the owner is that the builder treats their home as a commodity. So they give the best terms and conditions to make sure that they entice the buyer to want to go in there by giving them, closing cost concessions, etc. Where homeowners are, no, I shouldn't be giving that. If they kind of looked at it also as a commodity, which it really is, I think things would be a lot different. You got to conform to the changing market. I know we're saying prices reductions and all this stuff. That's just because you priced it too high.
And I think it opens up an opportunity for people to put their reality lenses on and say, hey, the market wasn't what it was years ago. Emotionally attached to my house, like every homeowner is, because they're not investors, have multiple houses. So for them, that house is everything that they own, and it's worth a lot. But at the same time, it isn't.
Yeah.
So it's like the market's going to tell you what your house.
The difference is when we got into a home to provide a roof for our families. We just didn't want to rent. We wanted to go in there because I've been a renter, and I put anything in there. If I painted it my way or if I did anything, that was at my expense. And when I left that unit or that property, I left it in better condition for that landlord, And so my whole ambition was, let me go and do these things and let it be for me. I wasn't looking at it when I bought back in 2000. I wasn't looking at it like, what's my appreciation and going like, this is going to be something that's going to leave. I didn't even realize those things until
I just want that
2023. I said like, oh damn, I bought my first house for $242 and now it's worth $575. This could be a business, right? This could be a good industry for me to get into. And that's what enticed me to want to get in there. But I never realized that the beginning wasn't for that.
Right.
It was for something different. So, look at it right now. If we made equity now, that's a great thing. I recuperate all the monthly payments that I made throughout the years and some. That's a win already. In addition to all the tax write-offs and all, that's a win already.
Yeah.
This, what I kind of laugh about here is with the mortgage rates have been continued to rise since the Fed Reserve meeting on December 18. Why don't we go all the way to September? When they reduced it by 0.5%, that's when they should really go, because that's when it really started.
We had the uptick at the end of November, early December, and then...
Yeah. Well, and here's to all our other, people that we were dealing with and other friends, that were saying rates are going to go down. I'm just going to wait. I'm not going to refinance right now because rates are going to go down. It's way too late.
That ship sailed now.
Yeah,
it's gone.
That's just to tell us all that, the federal government has a lot of influence where rates go.
There's an old saying, the bird in the hand is worth two in the bush. Like, what if we have right in front of you, that's better than not having two, right?
That's right.
And, I think sometimes we can just hold our breath a little too long, and then the moment is gone. And in this case now, anyone who did not take advantage of that back in early to mid-August is going to have to now just be forced to wait.
Yeah.
And my opinion is that this title summarizes the problem super adequately. Mortgage rates above 7% are clouding the housing market outlook. And it's a great summary because this goes downstream into an inventory problem, because we saw inventory get better when rates went down, and now it's going to get tighter because rates are up. I think it's going to negatively affect pricing if mortgage rates stay higher. Affordability now is bad again, or I'll say poor again. And now you have price sensitivity on the monthly payment side because rates are back in the 7 range, and 6 is more appetizing. All of this comes together in this whole new normal, which we've been telling people, kind of saying, not saying. Well, hey, look, they're going this new normal. It's not going to come back. You're not going to see 3% again. Don't hold your breath for 4%. They're getting everyone ready for a 6% interest rate world. And now we're at 7s though.
I think they killed all hope, and they kind of just said, okay, we gave you hope that we were going to go lower, but nah, never mind. We're just going to keep it at this. You guys, your hope's done. Like, don't even worry about it.
So here it is. The hope is every time they reduce the Fed funds rate, it's a hope to the community out there that doesn't understand what that really does. And here it is. The reason why it's that, because we're at a deficit of $36 trillion. 36 trillion, right? And so it's advantageous for our government to reduce that 0.25% because they also need to refinance that. And so that's how they save the money when they refinance. But that's not tacked on to the consumer. Yeah, it's great for you're going to see your 0.25% less on your credit card, on your car loans, but not mortgages. Mortgages is all to do with the 10-year treasury. You follow that follows also, how stocks are going to do.
Yeah. There's a lot of these are all interconnected.
Very.
Inflation, unemployment, the job opening and labor turnover survey. You're talking about average earnings. I mean, everything is interconnected. And then the Fed's decision as a result of their data is going to have a spillover effect. And right now what we're seeing is this spillover effect where what we thought was going to occur is not going to occur because another problem is bigger than the one they tried to solve.
That's correct.
So to try to squash inflation, there's another new problem, which is now there's stickiness of pricing. Now we have more debt than we had before. Now you have unaffordability. So you've created a new basket of problems while trying to solve the other problem, which still isn't solved. And I'm going to go to the mat with people on this one.
Yeah.
I am so sick and tired of hearing people on the news and TV saying inflation has gone down. That is incorrect. Inflation has slowed in its acceleration. It has not gone down.
Correct.
It has not gone down until you see a negative sign in front of the number and you see a negative in front of that handle. Until you see that, it has not gone down. It has only slowed.
Yeah, exactly. Just go to the store and buy groceries, buy anything. I was at the grocery store with Tanya, and I was just looking at a box of cereal. I'm like, Oh my gosh, they're no longer at
Like
three
three.
something. They're like $8 and change. I'm like,
Yeah.
And that's a small bucks too. You look at that like family size,
crazy.
you're hitting 10.
Yeah, I mean, look, here's the thing.
Crazy.
Cocoa
This
Puffs?
is a problem that affects
Inflation's there.
This is a problem that affects everybody. So I'm certainly not sitting here in this seat going, oh well, I'm just barking about inflation because I'm angry about it and I policy wise have a bone to pick. No, it affects everybody. It affects everybody that we know. And the issue is that if we continue to like paint over the problem and we never actually get to the root issue of the problem, it will never get fixed. Yeah. And then what's going to happen is unless people can dig themselves out of this hole by making more money, get a better job, get a second job, or if you have a second job, get a third job, pay down your debt, do a combination of all those things, you're constantly going to be chasing the price normalization. That is what this is. I'm not going to sit here and pretend like this is anything else other than price normalization because it's not. There's no plan on the horizon. There's been no plan that has been shared with us about how we're going to get prices back to where they were just a couple short years ago. There's no plan to do that.
So what do we do for mortgage rates to come down?
We have to have rampant unemployment. Well, that's the answer.
That's exactly what the article said.
You have to have rampant unemployment, which will curb spending, and then the hope is that by curbing spending, that will bring prices back into order. And then if we have more inventory of unsold things, then the prices can be marked down at the store. It's just this like second, third, fourth order effects kind of thing, which there's no direct correlation that it's going to help right now. It's all got this long on ramp and this long time frame of being able to be fixed,
chasing,
and it's not getting solved. This is what was supposed to have happened by increasing the Fed funds rate from March of 22 all the way until 24. This is supposed to be what happened over that 20-month span of them increasing rates. Yeah. Was to quell and calm down spending, but it has not done it by any stretch of the imagination where they wanted it to be.
Just feels like it's a water pipe bursting everywhere, and whenever you try to fix one place, it just bursts out another place.
Yeah, pretty much.
It's like,
I mean,
you can never get to solve the problem because it's always coming out through one way.
I'm clearly all amped up about this.
Yeah, no.
Because it's a problem.
Not at all.
And yeah, no, it is. And it's a problem, and I don't mind that I'm, demonstrating my frustration because I know that my external demonstration of this is how a lot of people feel right now.
Oh, 100%.
This is how a lot of people feel right now. I don't have any comfort going by the gas station and going, oh, instead of $5.50, it's $5.25. Oh, that's great.
You go to
I'm not calling nobody and texting nobody like, oh, I'm so excited. Gas is down 25%. I don't feel like that at all.
Yeah.
Why isn't it $3.50?
Off of L and Third Avenue.
Oh my God. Okay, fine.
Country Club. There's a
Yeah.
359.
I guess what, guys?
My point is, I'm having an external reaction. I'm sharing with you and everyone watching this that is shared by a lot of people internally, and they're privately and silently struggling because here's what happens: the people who are your past clients that are having this problem privately are calling and emailing, and they need the house to come to the rescue by pulling money out or consolidating debt or something like that because we're doing it. We see this firsthand here in the office.
Yeah. Well, and then when you said about unemployment and how people continuously like have multiple jobs, like it sucks because we're just chasing affordability, and by them trying to get another job to just keep up with the regular everyday like expenses, it's adding more fuel to the fire because there's more people getting jobs, even though it's the same person holding the multiple jobs, but it's still one person that's working all three of those jobs.
Yeah.
So it's like at the same time, it's like, dude, where's all this coming from? But at the same time, they need to work those two jobs to be able to just survive.
So what people should expect is elevated mortgage rates higher for longer. That's just it.
That's it.
I want to come here and say something better, but I can't. If I could say something better, it just wouldn't be true. So we're going to have higher elevated mortgage rates for a little bit here. It could be the entire first quarter. It could be until the unemployment rate spikes even higher than what it is now. I think it went from 4.2 to 4.1, like whatever.
And that changed rates today drastically.
That's a nominal change.
Like 0.5%.
But here's the thing, like it has to go up way higher, which means there has to be a lot more pain through hundreds of thousands, millions of households on the unemployment side before then we can see some sort of monetary effect that's actually going to be beneficial long term.
Yeah, I hear you.
It has to get worse before it gets better.
Our deficit even greater.
Well, it goes back to what I was saying earlier, you guys. It has to get worse before it gets better.
Over there.
No, I get it, but it's just going to be a hard Band-Aid to put on if that's the case that that happens.
Look, man, no one wants to face the music. They just don't. Let's just be honest. Like, no one wants to face the music. No one wants to be the bad guy. No one wants to say the truth because it sounds inconvenient and it's hard. But it has to happen. If we don't address these things and don't get it fixed, we're going to continue having this conversation, which I'm tired of.
We've been saying this.
It's going to be hurting people.
Plus.
Well, yeah, but at some point we have to see the other side of this, and it has to be at the policy level and it has to be on the market level. Yeah. It has to be on both sides. So